Good morning, everybody. Oh, little squeak there. Good morning, everybody. Good morning, everybody. Welcome to the Flow Show. Hope you're all doing well this fine day. It's a bit scary here in the UK. There's a big yellow thing in the sky giving off heat. Don't know what it is. I'm scared. I haven't seen that for a while through the wind and rain we've had, but nothing compared to what's going to be happening in Florida. So once again, we hope any of our ForexAnalytix folks are staying safe over there and that they are well through that event. Morning, Mr. K-Man. How you doing?
Morning, Ryan. Good morning, everybody. Yep, I'm seconding obviously what Ryan says about about most things about the hurricane. I hope everybody stays relatively safe. And then yeah, something strange in the sky here. I don't know. I'm a bit worried too. I just put on 3 tubes of sun lotion, so just to make sure I don't get completely burned. Yeah.
Do you have to sacrifice anything to keep it up there, or we just let it go? Anyway, right, jokes aside, quite a few headlines to get over today. Before we start, just want to bring your attention to our trader funding program that you may or may not know about, where you can scale up your trading by taking an assessment. Your maximum risk, obviously, is just that assessment price. So you can trade up to, well, I wonder what the latest is. You can still trade up to $1 million account. Okay. As I say, all the risk is just the assessment fee. And you can take up to 90% of the profits via the various options. Also gives you free access to the ForexAnalytix chat room for certain periods of time, depending on what assessment you take. We have got a few of our assessees, shall we call them, our TFP bods here in watching the Flow Show regularly. And there's even a dedicated chat room on our platform for trader funding program accounts, so you can speak amongst yourselves, but you also have full access to all the team and every piece of goodness on the platform. During the month of October, and I'm just popping the link up there to the TFP and the code, we're running a 20% off promotion. It's 20% off every assessment for the month of October. So if you were sitting on the fence, now's the time to go for it. And you've got all the support you need from the team here at ForexAnalytix to help you get through that. We're not just sending you off into the ether to get on with it. We'll guide you along the way as well. Right, let's get into what's been going on over in China. We're still in a situation where the market is, as always, you give it a morsel and it wants to take the whole thing. It's still looking for extra stimulus measures, growth boosting measures on top of everything they have done so far. Chinese Premier Li was out yesterday saying that they should unveil specific plans for policies that are being studied. So that means there's still potentially stuff in the pipeline. Said we'll study reserve policies for next year too. We in a chat room weren't quite sure what that meant when talking about reserve policies, whether that's talking about the RRR rate or other reserves. We'll have to wait and see, maybe for a bit more clarification. He also vowed more measures to support businesses. So the market has been getting its hopes up, as we pointed out last week, about expectations for yesterday, which weren't delivered. But I think maybe the market's getting a little bit, as I say, too greedy in terms of what China is going to, what bone China's going to throw markets. They have been doing an awful lot. I mean, this isn't new. All these easy measures may be a bit more kitchen sink, but it's not new. They've been propping up the property market and dipping in and supporting parts of the economy, electric vehicles and other parts for the last couple of years now. So it's not like they've been doing nothing and just started. So that's why I think the market is maybe a bit too expectant over how much China's going to throw at this, considering what they've done so far. But market's going to market, and we just pick up the pieces as normal. In other news regarding China, they've had more talks with the US Commerce Ministry people speaking to their US counterparts. They expressed concerns on the US's chip policy in a phone call. They said China is willing to work with the US to steer economic and trade relationships back on the right track. None of that is likely to work, and because there's far more geopolitical issues going on. China's backing of Russia over the Ukraine stuff, and everything else going on. So it's all tied together. It's not just trade as a separate thing, all tied together with the geopolitics. If ever we were to get a resolution over the Ukraine and Russia, that could be the trigger for then improving relations with China. But if we get those sort of things, we'll probably head in for a risk rally, the likes of which we've not seen for a long, long while. But as far away as that seems at the moment, we may be getting something from China because the Ministry of Finance is to brief us or their population on October the 12th about intensifying fiscal policy adjustments. So that may be an area where, again, the market gets all expectant for something and where something may come. So that's a date for the diary, October the 12th. Over in Japan, Economic Minister Akazawa says Japan is on the cusp of shifting to an economy where price rises are accompanied by wage hikes, but they're not quite there yet. Again, commenting on the Bank of Japan, said that UEDA told them they will adjust the degree of monetary support if the economy moves in line with forecasts, but that they can afford to spend time making that decision. So keeping it slow and steady. PM Ishiba has dissolved Parliament, as it was expected, ahead of the election to come on the 27th of October. Okay, I think that, not that I can remember, I think that means like normal government business is now off the table. We're into, or well into further campaign mode.
Yeah, we are in campaign mode. He already kicked it up, kicked it off. The opposition is complaining about the short time that they have. Noda was on the wire saying that well, he was really complaining about the short time that they only have to prepare for the elections. Yeah, okay. Well, the usual business, they can run the business that's ongoing, but yeah, I mean, there's nothing, there's won't be any decisions, nothing signed for the next 3 weeks. So it should, apart from the election campaign, get a bit quiet from the official side as well, unless, of course, I mean the FX is going massively one way or the other. Yeah, for the rest, I think Akazawa is just yeah, living a bit on what Japanese officials usually do. They live on hopium and then need to revise. But we will see. We have seen those big wage hikes. They can live on a bit of hope right now. Yeah, for the rest, nothing really new. An ex-BOJer said that he expects them to raise only in January. Now, of course, myself, I was saying that October is really on the table, but now that we have those elections, it's probably off the table, right? We need to probably wait for another meeting. It would be surprising that right after an election they raise rates. I don't think that would be I don't think that's in the pipe right now. But yeah, Maeda said January, but he said like it would take up to 2026 to get up to 1%. I mean, how slow is that, right?
Yeah.
You can actually start to think, well, if it takes you a year and a half to add 0.75%, of course the other ones will cut further. So there is going to be less differential. But if it takes you a year and a half to get up to 1%, It may take another at least 6 to 9 months at that rhythm from now before the Japanese whales are starting to really repatriate funds, and I think that's where now the risk is kind of shifting a little bit towards that side, if Maeda is correct, of course.
Yeah, absolutely. And we always got to remember there's Western time and then there's Japanese time, which is always about 20 years longer than we're used to over here. So, yeah, we always knew it was going to be slow and steady, and slow and steady it is. But I assume we're going to get the usual sources pieces a few days before the BOJ anyway, so that will steer things.
I think I think they also realize they have to, looking at what's happening in August, and we know it's not only down to the Bank of Japan, but even the Japanese officials keep on hammering on it that they don't want a repeat of this. So I think next move should be well telegraphed.
Yeah, exactly. Right, moving on over to the RBNZ, who decided to go with the 50 in the end, cut rates as was largely expected. They say that New Zealand is now in a position of excess capacity. The committee assesses annual consumer price inflation is now within its 1 to 3% target and converging on the 2% midpoint. They thought it was appropriate to cut the OCR by 50 pips to achieve and maintain low and stable inflation. They said that future changes to the rate would depend on the bank's evolving assessment of the economy. Members agreed that the OCR now at 4.75% is still restrictive and leaves monetary policy well placed to deal with any near-term surprises. They did discuss the respective benefits of a 25 versus a 50, and obviously decided on the 50. They agreed that domestic activity is weak and that the economic environment provided scope to further ease the level of monetary policy restrictiveness. Overall, they went with the weakening economy side as opposed to the taking it slowly side, and keep the momentum going by keeping that line in there about further scope to ease. No indication, though, whether they would go 50 or 25 in the next meeting or when they would next go another cut. So that remains to be seen. They're keeping their cards on that front pretty close to their chest. Kay, anything you picked out of the RBNZ?
Well, yeah, it's the one that I thought that could happen during the 50. Also, and they will, of course, never put that in any statement or may never talk about that. But I do think that the Fed's decision to go 50 has helped some of them to get over the line to do a 50 themselves. Maybe if the Fed wouldn't have gone 50, they may have only done 25. There was quite a bit in the statement about sluggishness, overcapacity, excess, a bit of slack arriving, or some excess stuff. They seem very cautious and leaving the door open. And just saw like a couple of hours ago, apparently Westpac said that they which is one of the major Aussie and Kiwi banks, they expect them to actually do another 50 in November. There, I find it quite surprising to come up with that now. Of course, they like to make predictions, or they have to. But I think that's a little premature to know what they may do in November. But they did hint at continuing on this course. So yeah, we can expect already them to signal a further cut in November, perhaps. Yeah, that's about it. I think technically Kiwi has broken a bit of a level, but it's slow and, well, like everything right now, or most of the things right now, it's slow going, and we are waiting. And dare I say, we may already be in pre-US CPI territory here. Yeah, I know we have the FOMC minutes, and it was a big cut later on, but it does look to me that the markets are already in pre-CPI mode, and perhaps that's why the Kiwi is not really falling out of bed, but just lost what a rate cut may do to it.
Yeah, and going back to the Fed can of worms on a 50. We were talking about it at the time, saying that if the Fed did go a 50 at their last meeting, it would open the door for everyone else.
Mm-hmm.
On a broad view, what situation are we in now where a 50 basis point cut is seen as just a normal move compared to the old days where it was a 25? A 50. If anyone went at 50, something, shit was hitting the fan or something. And now it's like, we're just going to cut 50, and this is just a normalization phase. It's not trying to counter, deep economic contractions or anything like that. What world have we moved into now?
I hear you. And the thing is, Ryan, I mean, it actually brings me back to what you said. Where was it? Last year, and then starting of this year, where they said like they don't want to make the mistake to be way behind, or they don't want to make the mistake to be too early and stuff. But then I think what the Fed did was they were well above 5%. And if you look at the bond market, okay, you've got what the market people say, like what the market is pricing in, but you have like flows, right? And if you are above 5% with your interest rates, you are going to attract a massive amount of money as well, in those money market funds and things. And then when it starts to slow, you need to do something. But I think the level where the interest rates were in the US was of the sort of saying that, okay, we can start to lower it, and depending on the metrics. But if we just take the global CPI, which is around 2.3%, I know the core is a bit higher and things, but it was coming down, and they waited for a long time. But I think it's somewhere a psychological move to put the rates back below 5%. It's not that they want to go all how shall I say well, no, a bit dovish then, but it's not as if they're going to put the rates at 2.5%, 3%, in my opinion. But they wanted to mark the start of a move. But I do think that 50s are not going to be the standard. I'm quite convinced that 50s are not going to be the standard, and especially not if we start to see labor reports where especially the unemployment rate doesn't accelerate. And of course, we all know the revisions and stuff, and people are only talking about that, basically about well, we don't believe the NFP numbers because they are going to be revised anyway. But on the other hand, you have the unemployment rate, and there it seems that not a lot of people are discussing or putting the unemployment rate in doubt. Okay, some may, but I do think that and their power actually sent the message pretty early, saying that we are going to look at the other side of the mandate, which is employment, and then we want to continue to support a strong economy, and that justified the 50 pp's. But now the way he talks to me is saying that whatever we are going to get later, unless we're seeing a surprise move. Well, especially I think on the jobs market, the surprise move for the worse, I don't think we are going to get any more 50s if we just go on a slow path. Okay, if of course we need to look at the data. We are all data dependent, but if we are on a slow path, I don't think that 50 is going to become a norm. I really think it was to the gunshot
Get them off lofty
at the
level.
start of the gunshot at the start of the raid, or at the start of a race, is always quite loud because you want everybody to hear it, and I think that's what we got.
Yeah. No, I think it's the lofty levels that are getting some of these to go. But it's funny how the RBNZ first went a 25 and then went to a 50.
Yeah. Well, and because they were still above 5% as well.
Yeah.
And perhaps they say like, well, I'm not really looking at the currency, because somewhere, if you look at the currency, you always like to have a relatively strong currency. But if your inflation is really coming down very, very fast, they still want to keep some inflation as well. So if your currency remains overly strong, like, and most people listening to us were probably not there, but I'm going back to the 80s, 90s, where Germany wasn't doing anything else but cutting rates, but still the German mark was very, very, very strong, and they couldn't get inflation going for any money in the world. And those central bankers, they are not 20, 30-year-old people, right? They are people who have been in markets for very long. And I guess part of the justification for the 50 pp's was also, if we keep our currency too strong, we may push inflation even lower. So I think it's been a very fine line, and you won't find most of it back in statements, but those guys, there's a lot going through their mind, I think, and there's a lot of little pieces to that puzzle. But yeah, I think it was kind of Fed related as well, that for the reason for them to bring their interest rates under 5%.
Yeah, and we have to remember Powell's last comment on that. The last time he spoke was, and he said that if the economy evolves as expected, they're going to go 2 more cuts for a total of 50 basis points. So
yeah,
leave
and
left him
actually the dots are
optionality whether
there.
it's 225s or a 50.
Yeah. Well, the dots are there. The thing
Yeah,
is, the surprise now, and again, everybody can put it in doubt, but the surprise now would be that the next jobs report is another bumper one, because then that's there is going to be a lot of rethinking to be done, a lot,
yeah.
as well, and really not only by the central banks, but I think by the market.
Yeah, and to your comment that you don't think 50s are going to be the norm,
No.
well, let's wait for the Bank of England to step up. If there's
Yeah.
one who'll join the club, it'll be those clowns, I'll tell you.
Oh
But
yeah.
we're going to wait a way to go until that one. Anyway, good discussion. Anyway, right, let's move on. France, the French government is apparently going to consider doubling electricity tax in 2025. That'll go down well. That will help push prices up as well, so that'll be good for inflation. ECB's Nagel getting a bit political, maybe going outside of the remit. He says that he fears slower growth and faster inflation if Trump wins in the US. It says inflation is on the decline, but must remain vigilant due to high core readings. ECB man Stornos from the Bank of Greece sees a case for 2 more 25 pip rate cuts this year and further easing in 2025. ECB's Villeroy and ECB cut is very probable and won't be the last. Casimir, one of the hawks, says he's not currently worried about the ECB undershooting the 2% goal. Can't rule out a rate cut at the next meeting, but not as convinced as media reports are on an October cut. It says we'll only get key data in December. I think we know who one of the dissenters on the GC is going to be at that October meeting. Kestrel Kazakhs, he's definitely found some dovish feathers. He says rate cuts are necessary as the economy is weak. Over at the Fed, Bostic economy is close to the Fed's target and moving closer. The inflation rate is still quite a ways above 2%. Collins says further rate cuts are likely needed. Future action is to be data driven. Says core inflation has moderated but is still elevated, and that it's important for the Fed to preserve the healthy labour market. According to a Bloomberg piece, those people trading treasuries are going the other way. They are starting to bet against all these rate cuts, or take the slower line of rate cuts, shall we say, from the Fed. Traders have turned net short on treasuries for the first time since April 2023, and apparently open interest in the futures market has collapsed since payrolls. So this is market now selling bonds over buying them when rates or when bond rates were up at in the 4%, and now they're going the other way. So obviously that's a bit of a no shit Sherlock, given where our yields are moving at the moment. But there's a bit of an elastic band situation with this one, where if yields get too high, then you're going to find buyers coming in. I think we're in the zone with rates here at 4%. But markets can always go further than you expect them. But anything up 410s, 420s would be very, very toppy, in my opinion, because that will put them bang on where the Fed are expected to cut rates to for the rest of the year. So, and if they're going to continue, that might make those bond rates a bit toppy, but we shall see. Kay, that 3-year note sale, a little bit on the soft side in terms of take up, bid to cover, indirect.
Yeah, a little soft, Ryan, but today we have the 10s, and perhaps that may be a little more interesting, but although the amount is obviously a bit smaller, but sorry, it may be a little more interesting, but the thing is as well, Ryan, will the market react to this? You could see a bit of flows, obviously. Especially after those people starting to turn around in bonds a little bit, but yeah, it's too close to the US CPI to really have a material impact, and that's what I think today. Unless we get a really big surprise, it's kind of like somewhere a data point when you have a relatively heavy week in auctions. They come as like little pieces of a data point, and they could have a bit of an algo move, same as the FOMC minutes later. But I don't think it will be lasting unless we see like a really big surprise. So yeah, the 3 is a little bit soft because yields are going up, and people probably are. Have enough of them right now, and don't want to increase positions at certain levels now anymore.
Yeah, absolutely. Right, moving on to Canada. Finance Minister Freeland says they still have concerns about the economic macro environment. They all added that it's very important to respect Bank of Canada independence. Mexico's Heath repeated that rates should stay put for longer. He was the one who popped up last week to say the same thing. He was the dissenter at the last Mexico meeting, so it's a bit of a repeat of that comment there. Right, all the Israel, Iran, Lebanon stuff going on. It's been headline city, as I'm sure you can tell. Apparently, we've had sources pieces out that Israel's going to refrain from attacking Iran's nuclear sites and focus on military targets. But there's been conflicted stories the other way to that as well. One big theme that's been bubbling, though, is that Iran is potentially putting some pressure on Hezbollah to look for a ceasefire. That may temper things if that comes to fruition. That's still ongoing. However, it doesn't seem like Israel, for now, is ready to stop what they're doing. And in fact, the US are getting a bit frustrated, apparently, because Israel have been reluctant to share any big retaliation plans on Iran with them. So it seems like Netanyahu is still hell-bent on going forward with retaliation, which presents a bit of a sticky situation, because if Iran manages to get Hezbollah into some sort of ceasefire, but that doesn't stop Israel, you could see a risk rally initially to go all the other way and actually make things worse, because then Iran and Hezbollah will think, well, we've ceasefire, so now we need to retaliate even stronger, and then we get an escalation. So this stuff is still bubbling strongly under the surface, and we're still at risk of headlines from that. So take care over that one. Right, that's it, all done and dusted from that side of things. Unless you got anything else, Kay?
No, Ryan, I think we covered everything.
Yeah, plenty on that
Go
one.
on.
Sorry?
I said no. Yeah, I think we covered
Okay.
everything for today.
Cool. Right, we'll stay with the Kiwi while it's on the screen, just after the RBNZ couple I want to look at. Kate, I looking at your chart earlier, you had your fib still drawn up to that one, didn't you? So we're on the 50, if you're looking at that move. Oh, get in there. So we're on the 50 of that one. I actually moved mine back up here to this high, which puts us through the 50. But it depends on how you're doing your own text. But there's a couple of different views on this one. Either way, we're in a support zone that we've been in, and we've seen plenty of action going back. So it's one of those sticky zones where you need to really use it maybe as a bit of a pivot area. If we're holding in it, then it suggests we may not be going further down. If we're breaking below it and finding resistance, then that keeps the downside momentum going. Again, this one is a bit of a double wind. It's got obviously the RBNZ, but it's also got US dollar strength behind it as well, a bit like we saw with cable the other day. So it's no surprise to see this one coming down. Gavin, you said Kiwi's not getting hammered on the back of this 50 cut. No, it's not. We've seen far bigger moves over RBNZ meetings. Obviously, the 50 was widely expected, so that limited the move somewhat. Just remains to be seen what happens now. Does it continue ongoing, or do we find a bit of a bottom? But I think, as we've all been saying, Kay just mentioned, we are getting into the US CPI orbit, so focus is not on the RBNZ right now. It's more so on the US. Aussie Kiwi, which, as you know, I was trading this one. Fortunate to get a bit of margin in the trade from this move down here. So this reaction has only just put me slightly offside of the rest of my position now. So I'm still happy to play this from the short side. My focus shifts a bit more to the RBA side of things now. But obviously lots of risks to be monitored in this one. If we were here when going into the RBNZ, we'd probably be up here right this minute, but we're not. So we'll have to see what goes on. For me, the levels are still valid. There's several views you can take of this one. If you take the long-term view, we're in this big old multi-year sideways range. And if the RBA stays on hold and the RBNZ continues to cut, then we're probably going to push up towards the upside of this range. And but for now, I'm still happy with the trade. Managed to take some profit yesterday. I am going to reduce the size of my entries now, just on the back of that RBNZ 50. But for now, I'm happy with the trade still going. Ali, you're up to all sorts. You got flipped out of cable. Let's see how that happened.
No, that's what I don't get, Ali, because you said you had your stop at 131.20. I see yesterday's high is only 131.
Yeah,
15,
12.
15.
Yeah.
Are you trading Are you trading something else than just spot FX? Are you trading futures also?
Or have you missed a one out of that 1.312? Yeah, let us know, Ali, what you're doing on that one.
12. But 12.
Yeah.
But you said you had your stop at 20 and you got stopped.
No, I think you missed a one.
Oh, you missed the one. You missed the one, Ali. So you had 12. Oh, okay. Yeah, but then 12, you were just below a micro level there, in my opinion. But okay, I'll let Ryan continue. Sorry.
Yeah, no, I was going to say same thing. Again, maybe your stop was a little bit tight, but where were you short? I'm just trying to find it. You short. Where were you short, Ali? Okay, you'll let us know. 131.72. Okay, so you made profit anyway. So you just mean you got stopped out on the balance of it before it went. Well, that's as they say in life, that shit happens. I've got the similar situation in dollar CAD. I was messing around with this 136.50 level yesterday. I did a little short in here with a stop reverse at 60. which obviously got stopped and reversed. Then we came all the way back under, and I got ticked out below 3 pips below my stop. You know, shit happens, mate, and then it's bounced since then. So, you know, you've got to put your line somewhere. Sometimes they'll stay valid and sometimes they won't. You know, as long as you made money, that's the main thing. Oh, no, you're short. Oh, come on, Ali, get your figures right. Short 130.82 in cable. So you've shorted right down here against these prior lows, pretty much.
I think that's maybe where the trick went wrong.
Yeah, I think, and you one of the
anyway,
trades you did. Yeah, one of the trades you did the other day, earlier this week, I think, Ali, just you're a bit, well, obviously in my eyes and where I put my levels, you seem to be a bit in the middle of some of these moves, rather than maybe having a bit of patience and waiting for some of the other levels. You know, we've been pissing around this 130.80. I've had it on my chart. We've seen action there, but right now it's not really doing anything. It's waffling about it. So when you get moves like that, maybe you need to just rethink about your strategy and your levels, and maybe assess where your better levels are for entry. But it just seems the last couple of trades you've been a bit in the middle of some of these intraday moves. So that's when you've got to look at things and adjust things. Cable for me, 130.50, 130, and we've largely held there on these first tests. So if we break there now, then we're probably heading to 130, and then that's going to be the next level for me. I'm not overly keen on jumping into pound longs right now, particularly as we're circling round to the UK budget, which I don't think is going to be good news for me living here, nor maybe for foreign investors and big money who already seem to be exiting the UK. But as I mentioned in the chat room earlier, 99%, 95% of what comes from the budget is not going to be market moving for the quid. It's going to be fiscal news, it's going to be growth news, and it's going to be big tax news like corporate taxes, capital gains, property taxes, that sort of thing. Those taxes that affect big investors, foreign investors. So that's the stuff that's going to move it. But I'm not in the bullish pound camp on a fundamental basis ahead of that budget. Technically, yeah, there's some levels in play. Euro sterling, the snail, that's holding up. I thought we might find a range probably from 60s, 70s against here, but it decided to go to 50. So I think we're probably setting up for a bit of period, maybe banging around between 84, 84.20 and anywhere down here to 83.50s. But it's maintaining this move off of the lows. And as I say, if we do get further weakness on the budget stuff, then maybe we start creeping through. But unless we're above and holding above 84.20, we're still in this more longer term bearish phase, in my opinion. One more, and then I'll bang it over to Mr. K-Man. Euro dollar. Another one. Everyone's moaning about the pace of this one.
I'm so glad that you're covering euro dollar.
Do you want it?
No, all yours, mate.
Yeah, we've got this 60 level, and we just can't get below it. Okay, we are setting up lows around 50, so that's got to be respected. And you know, we've seen prior action here, but on a longer basis, because this 109.60 is a bit more of a longer term move. It does go back a bit further. We're not managing to hold below it. Okay, so you need to take 109.60, 50 now as a bit of a zone. We're going to need to break that to get further downside. But even then, there's traffic all the way down to the figure and then below the figure. So it's going to be, I think, a bit harder without any big news to get on down through these levels, unless you know, the dollar's really picking up a head of steam because yields are rising, whatever. It was a bit better up here because we had a bit of a wider range to play between. You know, some big levels, 110, 112. That was a big game being played there. So we did get a bit more volatility. But here and now, while we're waiting for the CPI I think things are going to be a bit slower, and that's dangerous because 110 that held, and if you're short, that's fine. You're on the right side while that holds, but the closer you get to CPI, that can be a potential big move. You've got to wonder what to do with a trade when you're in a 40, 50 pip range facing big data. So if those of you are short, if you find that going into CPI maybe we're down below 109.30s, then you've got a bit of margin to play with. But otherwise, I think you need to be careful with shorts going into that data. Kate, I'm passing it over to you, mate.
Yeah, just on while we're switching screens, I am a slightly short euro dollar, but I've reduced it just because of the snail's pace of this, and because we are, as Ryan says, getting into the US CPI orbit. So I've just reduced the position, took a few pips, and I just wanted to reduce my risk to virtually zero, actually, if I would get done on the average now in the position. You were asking about gold. Yeah, and the other day you saw it pretty right as well, Ali, leaning towards the short side. So yesterday we had one try, and the second one just went, and that was when this Israel, Lebanon stuff came out. Oil got a knock on the head, and the metals as well. All of a sudden, we went through the triangle here, the prior bit of support. This puts us now on I think the resistance is somewhere up in the 2630s now again. So for as long as we're below, there is a possibility to go and see the prior break level, in my opinion. There is a few bits here as well, low 26s. But again, we are never far away from a headline concerning the Middle East situation, perhaps even the Ukrainian situation, who knows. And we are ahead of the CPI. So anything can really happen. I think with the Middle East situation being what it is, if we get a weaker reading tomorrow on the CPI, we could completely shoot up again and go and retest the highs. If we get a stickier one though, there is perhaps room before any other major geopolitical news to go and have a look at 2590s, and why not even here, which is the 50% around here, around 2580. I wouldn't really rule it out, to get back down there, because it was hanging around. People were waiting for the next news on probably Middle East, and it was hanging around here despite those better US numbers, those higher US yields. So, but finally, the longs, or at least the last longs, have to give way with time. I think the longer term longs, they are long from here, or maybe even below, and they won't change anything, in my opinion. On the longer term, right, is not going to change until we get back below 2530, and that for the more medium term is to me going to be key levels. But in the meantime, yeah, there is a bit of room to drift back down to 2590, 2580. I would think that ahead of the CPI, 25.5 will be a bit too far, a bridge too far, And then on the top side, you were saying, Ali, somewhere in the 2620s, is that it? Let me just scroll quickly back to what you said, 2480. What is that? That's just above this prior low, yeah. Okay, I mean that's your short-term trade. Oh, okay, and above those little highs that we saw after the dump. All right, okay, yeah, okay. Intraday, you could trade it on the back of it. Another one which is interesting. I showed you this support zone here. We came and have a look at it inside it on silver. Now we are bouncing again. will depend on what China does, what the US CPI does, to see if we can get a retest in there. Since I'm going to be off again for a few days, I've placed a bit just above here actually, in case we see a move down below the box, and then I think it's going to start getting time to load up the longer term again. Well, that's my view anyway, for then to continue a move higher. But let's see what the CPI tells us tomorrow. Yeah, I can look at Euro Aussie, Himashu. This one to me. So we are still back into well, it has been traversed a lot of times, this trend line, but I think we are kind of back into this zone. I think this Euro Aussie rally had to do with risk, had to do with China, had to do with the outlook of the RBNZ and stuff. But I think overall still, I would feel more comfortable leaning into those levels. So anywhere closer to 164, I think it could get a bit toppy there again. Okay, I think risk should really falter if it has to go through 64 and a quarter. Okay. I think that's a level where I'll be looking at getting perhaps short again. In the meantime, prior I highlighted this 160, the figure 160 and a half was a pretty decent zone, and that held, and we saw a pretty big rebound there. So that's your bigger zone right now. That's what I think. And inside, there's a bit inside this 162 and a half has always been a little bit of a level around which we saw a bit of acceleration. You see, it held there, but if you get through it, it tends to accelerate a bit. So watch out where we are on closes around 162 and a half. Whether you're above or below may just be good enough to tell you whether we are going to test the highs or whether you're going to test the lows. I have no intention of doing much right here with this right now, because I think we are somewhere in the middle of the range in the Euro Aussie right now. There's one here that I'm keeping an eye on, and is dollar Swiss. And if you look at, I'm usually not a big watcher of clouds for things that are not related to the yen or the occasional euro dollar, but that I do use it for Aussie and Kiwi from time to time, because I know that the Japanese are very much involved in the Aussie and the Kiwi as well. So I like to follow it. But if you look at the dollar Swiss here, when dollar Swiss started to come down and Swiss catching a bit again, there's two things that I quickly want to say about this before closing. Is that once we've broken below here, we only had one close inside in July, and then we started to move lower. Now I think we are potentially at an interesting crossroad, whether it be in price or in time for the dollar Swiss. Of course, we have the US CPI tomorrow, but we are starting to close back into the cloud, so that it may mean that we found somewhere a bottom. And also, what I've been saying yesterday is that we saw those Swiss reserves, and I think they hint at SNB potentially having been in the market for a little bit, not a lot, but a little bit in the month of September, start of October. So we may be at some crossroads here in the dollar Swiss, and that will be confirmed if ever we start to move back where we stopped last time, and that is here. Let me kill the cloud. 86.05. I think if we break above 86.05, we could potentially be off to the races in dollar Swiss. And that is about all that I had to say today. Ryan, back over to you, mate.
Yeah, thank you very much, mate. That'll do us for today, I think. I wish you traders all a great day ahead. Another bit of a quiet one this afternoon. What we've got coming up? Mexico CPI and that's about it in terms of important data. So we're going to be headline watching again. Thanks, Kate, as always, for your stuff. And yeah, have a good one, everybody. We'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.